Alright, bet. Today is the 27th of June, being a Saturday, and this video is simply just going to be doing a weekly review for the week that just elapsed, which would be from the 21st of June all throughout the 26th of June. Now, I haven't done a weekly review in about 2-3 weeks. It would have been this week that I last did one, and I did annotate this week, and then I didn't annotate the week that happened after because it was just a consolidation week. But jumping into the weekly review for the week that just elapsed, so we have the previous week's range right here. So we have the previous week low, previous week high, equilibrium of the range, and then we have the weekly opening. Now, even just taking a look at this, I actually forgot to annotate a Kraken correlation that presented itself here with YM. So YM ended up engaging with this high, and we ended up seeing NASDAQ as well as ES fail to follow suit. And then as well as the fact that with this previous week range, last week's trading had a bank holiday on the Friday. So this weekly range is only projecting Monday all throughout Thursday. And then dropping down and taking a look at the daily. So we have another Kraken correlation that presented itself here. So not only did YM engage with this high, NASDAQ failing to follow suit as well as ES, but we had an engagement with this high as well on YM, ES and NASDAQ failing to follow suit. But we have that previous week's range, so previous week low, previous week high, and then we have the equilibrium, and we have that weekly opening coming in right here. So we have Monday, Tuesday, Wednesday, and then Thursday, and then lastly, of course, being Friday. So we see that the week opens and we print an indecisive candle immediately for the Monday's trading. So this would be referred to as our whipsaw candle. And then we see Tuesday, heavy deliverance down towards sell side, engaging with that previous week low, closing below these two up close candles, making this an order block. So we have a series of up close candles, series of down close candles. And if you've watched the PD array matrix video that I released maybe a couple days ago, we have this being your old high, then you have your rejection block, your order block, your fair value gap, and this would be our mitigation block. Like I was mentioning in that PD array matrix video, this is the asset that failed to engage with this high. Normally with a breaker block, you're looking for a bearish breaker block. In this case, it would be a high, low, higher high, lower low. In this case, we only have a high, low, lower high, lower low, making this a mitigation block. But continuing on from Tuesday's deliverance, engaging with that previous week low, we then have Wednesday delivering down towards sell side and then closing back up in the range of the previous week, forming a daily SIBI. And with the formation of this daily SIBI, we end up seeing Thursday delivering into this daily SIBI, as well as engaging with that daily order block again, as the day before that being Wednesday engaged with it. And then we have that deliverance down towards sell side, closing underneath the previous week low. And then we end up seeing Friday continuing that same delivery motion. So again, forgot to mark this out, but this candle right here, being the Wednesday candle, would be deemed a propulsion block. So we ended up seeing this up close candle engaging with this order block. When an order block has established itself in price, in this case being a bearish order block, so a series of up close candles, if a series of up close candles engage with that order block and then we see a closure below the series of candles that engage with that order block, it is then deemed a propulsion block. And propulsion blocks invite for very expansive price action. They're utilized for expansion, and they're very sensitive PD arrays in terms of we don't see any closure inside of this propulsion block. Now, I actually do wish I had this propulsion block marked out and projected out in time so that we could see how Friday was utilizing it, but there are other PD arrays here that are being utilized. But dropping down into the hour 4, we have that weekly opening, and then we also have that previous week range. So previous week low, previous week high, previous week low, and then we have the previous week high right here. So the week opens, we deliver towards buy side, and we fade that previous week high. Now, I'm pretty sure I'm also going to be taking a look at the commentary that I had over the course of the week, but I'm pretty sure it would have been Monday's price action. I was projecting for that previous week high. I was looking to see that previous week high being engaged with, potentially that all-time high as well, and then that to serve as a point of inception for that sell side delivery motion. So with this deliverance towards the previous week high and failing to engage with it, Kraken correlation establishing itself in price, we end up having this next candle delivering down towards sell side in a very heavy manner. For one, correcting this devil's mark on this candle, as well as closing below this imbalance that resides here. Again, low-key forgot to mark this out, but our 4 bullish imbalance resides right here, and we end up seeing closure below it, and we can just take an acknowledgement as to how it's being utilized. I also have a standard deviation projected towards sell side, anchored to this candle's close all the way down to this candle's open, being our body standard deviation, as well as a wick standard deviation anchored to this candle's high all the way down to this candle's low, -2, -2.5, in alignment with the -4, -4.5 of the body standard deviation, as we know. And now that I'm speaking about standard deviations, I even forgot to mention that there are daily standard deviations anchored here. So we have a daily standard deviation anchored to the close of this bullish candle all the way down to the open of this bullish candle. So just anchoring it to the order block, that would be our body standard deviation projecting for sell side. We see that -2, -2.5 projecting for this segment of price action, as well as the -4, -4.5 resting inside of that -2, -2.5 of the wick standard deviation, which is anchored from this candle's high all the way down to this candle's low. So switching back onto the hour 4 chart, observing that deliverance. So we have the engagement with this bullish imbalance acting as an inversion for a value gap, and this is a form of a change in stain delivery. So when we're looking for a point of inception to present itself, there are 2 forms of change in stain deliveries that we can look to align ourselves with that motion of delivery that is potentially going to occur, in this case being sell side. So this being an inversion for a value gap is one form of a change in stain delivery, and then the next form of a change in stain delivery would be the formation of an order block, which would be your change in stain delivery at a point of inception. But we have that engagement with the inversion, and then we have that deliverance down towards sell side. We close below the weekly opening, and then we end up being rather shy around the equilibrium of this range. Next candle slamming down, continuing that sell side delivery motion, engaging with this segment of price action that resides right here, and then ultimately continuing that sell side delivery motion, engaging with that previous week low and the -2, -2.5 of the body standard deviation that is anchored to the series of up close candles. So we end up reaccumulating our orders inside of this imbalance right here that displaced through the previous week low, and then we continue that sell side delivery motion. Now the thing is, the reaccumulation of orders isn't sufficient here in terms of we don't retrace above an equilibrium of the range that had been established in price. So we engage with this imbalance, which displaced through the previous week low, and then we continue that sell side delivery motion. Now, again, forgot to annotate it, but there's a cracking correlation that presented itself in price right here. So NASDAQ engaged with this candle's low, with this candle, and ES failed to follow suit, which invites for this very wicky price action that occurs right here during Wednesday's price action. And then during Wednesday, we see that deliverance down to engage with this hour 4 imbalance that resides right here, as well as this order block, hour 4 order block. So a cracking correlation is present in this segment of price action. ES engaging with this candle's low, NASDAQ failing to follow suit. Order block right here, we never seen it engaged with, being the body of the order block. So the body of the order block wasn't engaged with, only the wick, and then we end up delivering down, engaging with this order block, and then that invites for that buy side delivery motion that we seen at the end of the PM session for Wednesday. And with this buy side delivery motion, we end up engaging with that daily order block, as well as the fact that we also deliver into a premium of this range right here. So from this candle's high all the way down to this candle's low, equilibrium coming in somewhere around here, we deliver above the equilibrium, as well as engaging with that daily order block and the daily SIBI that presented itself in price. This would be during Thursday's price action, very heavy sell side deliverance towards sell side after engaging with the daily order block as well as the daily SIBI. And we can also take an acknowledgement as to how respective these hour 4 candles are of our daily PDRAs, being this order block and SIBI. We're not seeing any closure above the daily order block on the hour 4 time frame. We're not seeing any closure inside of the daily SIBI on the hour 4 time frame. So a heavy sell side deliverance occurring during that Thursday's price action. Standard deviation anchored from this candle's high all the way down to this candle's low. -2, -2.5 presenting itself, which is where the low of the week ended up forming. But with this heavy deliverance down, we end up forming an hour 4 order block, which was never engaged with, as it was overlapped with an hour 4 SIBI, which was engaged with, inviting for that sell side delivery motion to form the low of the week. And then this would be Friday's price action, hour 4 SIBI being utilized. Again, we're seeing how rather respective the candles are being of this hour 4 SIBI. We're not seeing any closure above the consequent encroachment of this hour 4 SIBI. The wicks are delivering above it, but the bodies are being respective. Once again, just tying it back to the PD array matrix video that I dropped a couple of days ago. When we're observing fair value gaps, we don't want to see closure above or below the consequent encroachment of the fair value gap, depending if it's bullish or bearish. In this case, it's a bearish fair value gap. We don't want to see body closure above the consequent encroachment. This is a way for us to gauge order flow in terms of, okay, we can still look to seek that sell side delivery motion. Price action was being respective of this bearish fair value gap. And then before I move on, dropping down to the hour 1, we can also take an acknowledgement. This segment of price action right here, we can see how this candle is engaging with this hour 4 SIBI, but more importantly, what it's actually engaging with would be the previous week low. So we can see how price action delivers right into that previous week low, and then we snap right back away from it, again, continuing that sell side delivery motion. And then dropping down, taking a look at the hour 1 chart, being a whole lot more descriptive of what we have going on. So we have Monday, Tuesday, Wednesday, Thursday, and Friday. So starting at that Monday price action, we have that weekly opening that presents itself Sunday 1800 opening. And then we have that deliverance towards buy side fading the previous week high, cracking correlation established. And then a change in stay in delivery presented itself here. So these series of up close candles, one down close candle confirming our hour 1 order block, and we see price action engaging with this hour 1 order block, as well as the hour 1 SIBI that confirmed the order block. Once again, very respective price action. We engage with this hour 1 order block right to the tick. We don't see any closure inside of this hour 1 SIBI. We simply just reject it instantaneously. Now, with this segment of price action, I have a standard deviation anchored from this candle's high all the way down to this candle's low. And then you have your -2, -2.5, -4, -4.5, which is where the low of the day for Tuesday ended up forming. So we have Tuesday, 1800, immediate engagement with this hour 1 order block, standard deviation anchored from this candle's high, all the way down to this candle's low, projecting for a -2, -2.5, -4, -4.5, and we see Tuesday very heavy deliverance down towards sell side. And this deliverance occurred ahead of our New York AM sessions. So this was during Asia as well as London, and then we end up having the pre-New York AM as well as New York AM presenting itself within this segment of price action. And we can take an acknowledgement as to how uninviting this price action looks in terms of we don't want to go anywhere because we have just expanded previously right here. So we see an expansion during the Asia and London session. This is going to invite for the New York AM session to not offer as pleasant conditions as one would like to see. And these conditions end up continuing during the Wednesday price action. So we see this consolidation occurring during the Asia and London session. During the Asia session, we ended up engineering time-based liquidity. So we have the Asia low coming in right here. And then previous day, we have the New York PM low coming in right here. So TLP presenting itself in price, as well as the fact that it is time-based liquidity, serving as a very nice draw on liquidity. So with the Wednesday price action, during that New York AM session, we end up having this deliverance towards buy side and then heavy deliverance down towards sell side, clearing up all of this TLP. And then during that New York PM session, we ended up having this power hour move towards buy side. So this is actually a position that I executed on and posted on the YouTube channel. And this deliverance down towards sell side, what we're engaging with would have been the hour 4 order block, as well as the hour 4 BISI that resides right here. So naked eye projecting it out in time, we can see how price action engages with it, and it invites for this very, very aggressive deliverance towards the buy side. Now with this deliverance towards the buy side, what we're doing is delivering towards this daily order block as well as this daily CIBI, and we end up forming an hour one order block right here. So this is a valid order block, series of down close candles engaging with sell side, series of up close candles closing above the series of down close candles. And with this buy side delivery motion, a cracking correlation ended up establishing itself here. So Nasdaq engaged with this candle's high, ES failed to engage with this candle's high. At the same time, we ended up seeing Nasdaq engage with it. So we have Thursday opening up here at 1800. We retrace into this hour one fair value gap, and then we continue that buy side delivery motion towards the daily CIBI again in a very, very high resistance manner, as well as delivering above the equilibrium of this range of Tuesday's range. So from this candle's high all the way down to this candle's low, equilibrium coming in right here, we deliver above that day's range. And then during the New York AM session, we end up having very aggressive sell side delivery motion, engaging with all of this high resistance liquidity, as well as displacing down below this BISI, and a cracking correlation ended up establishing itself here, which is where the low of the day ended up forming. So again, I actually ended up taking a position on this right here as well for the low of the day. So we've seen that retracement back into this very aggressive range that occurred during the New York AM session. And then standard deviation is anchored from this candle's high all the way down to this candle's low, projecting -2, -2.5, -4, -4.5. So with the cracking correlation presenting itself in price, inviting for this buy side delivery motion, we're retracing back into this range, engaging with this hour 4 CIBI, as well as the previous week low, as well as the high of this bullish order block. And when I say high, I'm referring to only the bodies. So we're only paying attention to the bodies of the order block. And then cracking correlations are establishing themselves in price during this deliverance into this hour 4 CIBI, as well as this previous week low. So we end up seeing Nasdaq engaging with this high, ES failing to follow suit. Nasdaq again engaging with this high, ES failing to follow suit. Right here is a 3-drive pattern, and then we end up seeing another cracking correlation presenting itself during Friday's trading. And the asset that presented this cracking correlation would be Russell. So we end up seeing Russell engaging with this high, Nasdaq, ES, YM failing to follow suit, inviting for that sell side delivery motion. Now I have a standard deviation anchored from this candle's high all the way down to this candle's low, -2, -2.5, projecting in alignment with the hour 4 standard deviations as well. But from the engagement with the hour 4 CIBI, previous week low, hour 1 order block, we end up having that sell side delivery motion. Again, this is occurring during Asia. We're seeing expansion occurring during the Asia session. So from this candle's high, or in fact, it would be this candle's high. So from this candle's high all the way down to this candle's low, that is your Asia range. And we can take an acknowledgement as to where price action resided over the course of Friday's trading inside of Asia's range. We didn't engage with the Asia low, neither did we engage with the Asia high. So we have that deliverance down towards sell side during the Asia session, engaging with the Thursday low of day as well as the Wednesday low of day, and then a cracking correlation ended up presenting itself in price here. So YM ends up engaging with this candle's low, Nasdaq and ES fail to follow suit, and that invites for that buy side delivery motion that we end up seeing over the course of Friday's trading. And with this buy side delivery motion, we end up seeing price action engaging with this hour 4 CIBI, inviting for sell side delivery. And then we have the New York AM session opening up right here, deliverance up towards buy side, cracking correlation established itself here. So ES engaged with this high, and we ended up seeing Nasdaq failing to follow suit. So with ES engaging with this high, it is also engaging with its respective Asia high. So time-based liquidity cracking correlation presenting itself there in price, inviting for that sell side delivery motion. And this would have been where I actually took short positions during Friday's trading. So I shorted the high of day as well as the high of the PM session for Friday's trading. Now, one could pose the argument and say that this isn't the high of day, and this is actually the high of day. And that argument isn't incorrect. They're correct by saying that, but it's only correct if we're observing the settlement opening of a daily candle being that 1800 opening. When it comes to framing power of threes, specifically a daily power of three, there are two power of threes. There's your 1800 power of three, and there's your midnight opening power of three. Midnight opening is our interbank price delivery algorithm. Midnight opening is where smart money deem premium and discounted is what they're framing their power of three off of. Now, sometimes 1800 power of three as well as the midnight opening power of three are in alignment, and that is a very nice day in terms of its deliverance. When they are not in alignment, we end up seeing days like this occur sometimes. But we have that deliverance down towards sell side from this hour 4 SIBI. And to be quite honest, we could end up seeing this week open with a new week opening gap just displacing down towards sell side. More specifically, this weekly opening right here, which is in alignment with an hour 4 standard deviation, this hour 4 standard deviation, and then we have an hour 1 standard deviation projecting just under it. But this weekly opening serving as the drawn liquidity for the next week's trading that is about to commence. But yeah, that would be it in relation to the weekly review over the course of this week's trading. Now, simply just going to be taking a look at the commentary that I had over the course of the week, because like I mentioned before, if I'm not posting on the YouTube in terms of daily reviews, weekly reviews, X, Y, and Z, I'm more than likely just yapping in my Telegram. So I've filtered out most of the yap, as well as the fact that we're not going to be taking a look at the trades that I took over the course of the week, because we're just going to be here for a lot longer than we should be. But taking a look at the commentary for the 22nd of June being a Monday. So this would have been the first piece of commentary. Midnight opening standard deviation -4, -4.5, projecting above the previous week high. So what we're taking a look at would have been, can try our best to take a look at, would be a standard deviation anchored. So we have that midnight opening. We have a standard deviation anchored to the leg of our midnight opening. We see that -2, -2.5, -4, -4.5, projecting above the previous week high. And then I sent another image saying TLP is present on the M15 and devil's mark on the hour 4 candles. That 2 a.m. and 6 a.m. hour 4 candle have devil's marks on the opening of them. And then I then further went on to say that 9:30 will just offer a sense of clarity in relation to how the session should be navigated. So the image in reference would be that midnight opening standard deviation and then a very clear trendline phantom that resides right here, as well as the fact that we had our 4 devil's marks in price. These are serving as clear drawn liquidities. So going into the day, I would have been looking to see that previous week high being engaged with, and then a point of inception to establish itself for that sell side delivery motion. And if we just switch back to the weekly review chart to observe the devil's marks that I was speaking of, it would have been where we had that inversion for value gap. So you have this candle being a devil's mark, as well as this candle being a devil's mark right here. These would have been serving as a drawn liquidity. Dropping down into the hour 1, we can see how there are devil's marks presenting themselves in price here as well. And then on that 15-minute, it's just presenting itself as a very clear trendline phantom, which is serving as a drawn liquidity. So that would have been all of the commentary for Monday. Moving on to Tuesday. So first piece of commentary would have been open the chart to see a 1K point dump on the NASDAQ. Did not see it coming. Would have seen it coming if we engaged with the previous week high, but we faded it by a couple of points, quite literally a couple of points, like 2-3 points. But we know that YM presented that cracking correlation to permit for NASDAQ to fade that previous week high, which I later, confirmed for myself at a later point in time. But the images would have been this. So this is just an hour 1 chart. We have that deliverance towards buy side during Monday, fading the previous week high. Midnight standard deviation anchored from this candle's low all the way up to this candle's high, -2, -2.5. This is where smart money reversal occurs. We have the formation of an order block right here, standard deviation anchored from this candle's high all the way down to this candle's low, -2, -2.5, -4, -4.5. And then we also have that deliverance engaging with this order block and this SIBI anchored standard deviation, -2, -2, -2, -2.5, -4, -4.5. So like basically everything that's being annotated on the chart right now is basically what was on the weekly review, except this is just occurring live in time as the days or the candles are printing. And then the next image would have simply just been a 15-minute chart, just observing this dump very, very heavy. Now, in relation to this very faint orange line, this is actually our contract rollover gap. So that is what that line is, because we rolled over contracts not too long ago, maybe about 2 weeks ago. And whenever a contract rollover gap occurs, more often than not, it's going to present a void in price. And this is a time-based void, which is very important to pay attention to because it serves a purpose in price. If we're paying attention to this very faint orange line, we can see that the consequent encroachment was utilized during the previous week's trading to form that low of the week. So the gap is layered out in quadrants. So you would have the high of your gap, upper quadrant, consequent encroachment, lower quadrant, and the low of the gap. Consequent encroachment being engaged with right here to form the low of the previous week. And then that would have been all the commentary for Tuesday, moving on to Wednesday. So the first piece of commentary would have been the New York AM may have potential today, looking at the previous day equilibrium to serve as a drawn liquidity. So the data I'm referring to would have simply been the deliverance over the course of Tuesday. So we have the 1800 coming in right here, and then we have the close of Tuesday, or yeah, the close open of the next day coming in right here. So this would be the low of Tuesday, and this would be the high of Tuesday. Equilibrium coming in somewhere around here. So I was looking at that to serve as a drawn liquidity, and then taking a look at the M15 chart. I was stating this because we ended up presenting a cracking correlation under the true day opening after engaging with this imbalance that was located under that true day opening, being that midnight opening, and then looking for potential closure above for a change in staying delivery, anchoring standard deviations ahead of time in order to see what is a potential target. And we have that previous day equilibrium. So from this candle's high all the way down to this candle's low right here, we have that equilibrium. We see that this standard deviation, which would be an Asia standard deviation, projected for that -4, -4.5 as well. And then about 2 hours later, sent in M15 chart saying potential removed for me to speculate that the previous day equilibrium is going to serve as an intraday drawn liquidity for today. And I would look to see more framework during the New York AM session to present that previous day equilibrium to be a drawn liquidity. So just taking a look at the chart, we do end up having the formation of an order block, but we don't end up seeing price action utilizing it in an efficient manner. We end up just displacing back down below it, continuing this sell side delivery motion after a cracking correlation established itself in price. So we had the formation of the order block. With this deliverance up towards the buy side, cracking correlation established itself, and this high would have been Asia high, and that invited for that sell side delivery motion. And then just a couple minutes before the 9:30 opening, I sent in a chart of NASDAQ as well as ES, our one chart, stating that I could frame both sides. If sell side delivery was to occur, the standard deviation projecting for the weekly opening is terminus, and then the -2, -2.5 is resting just above an hour 4 BISI. And then if buy side delivery is to occur, standard deviation projecting for above the previous day equilibrium and an hour 1 SIBI. And then further went on to say that observing ES to get a better idea of order flow, because price action is being held in a very tight range. So NQ and YM are just over exaggerated assets. So to be quite honest, we can clearly see that NASDAQ is being held in a range, but we can very visibly see it, ES is being held in a range right here. You don't want to engage with this type of price action. It doesn't look inviting. And then the next piece of commentary I would have sent in the same day, being Wednesday, would have been 5 minutes after the 9:30 opening, displaying the M5 chart, saying not surprised to see this wayward type of price action occur one bit. Being able to frame both sides is why. And then taking a look at that chart, we end up seeing 9:30 open, deliverance down towards sell side, fading the Asia low, and then deliverance back up towards buy side in a very aggressive manner. And then next chart would have been M1, first presented fair value gap of the AM session for Wednesday. A first presented fair value gap this big is a trap, a red flag promoting headache price action. So taking a look at the chart, this was the first presented fair value gap of the 9:30 opening. And you don't like to see a fair value gap this big, or especially a time-based fair value gap being a first presented fair value gap, especially when we can frame both sides and we don't have a definite idea in terms of where we want to see price action go. We can see price action delivering towards sell side, and we can see price action delivering towards buy side. This type of fair value gap just invites for very poor price action. A couple hours later, simply just sent in a chart, said headache price action like stated. Being able to see and anticipate poor conditions ahead of time is just as important as being able to see good conditions ahead of time. So knowing when not to engage with the markets is just as important, if not more important, than knowing when to engage with the markets. Now, there are confirmations as price prints live to confirm a bias in terms of confirm the bias of price action is going to be clean today, price action is going to deliver in a very nice manner, or price action is going to be very poor. If I'm going into a session with a bias of I think this session is going to deliver in a very poor manner, I'm going to look for confirmations in price to confirm that idea. So the first presented fair value gap of the AM session was the one that confirmed it entirely for me in terms of we're more than likely going to be very attracted to this first presented fair value gap, basically just married to it. We don't want to go away from it. We want to stay around it. So taking a look at the chart, we can see price action being very, very poor. This is very poor price action. The only point in price action that was clean was the engagement with this low, which I did want to take longs from, but it did not engage with the order block that resides right here. It simply engaged with this imbalance, and I did not execute off of it. But that was the only clean point of price action up until this time, being 12:25. So this is during the New York lunch session. And we can even just take an acknowledgement as to where price action is. We're inside of the first presented fair value gap. We can also take an acknowledgement as to how price action is printing inside of this first presented fair value gap. Very Wkly price action. We don't like to see this. It's always, we want to see more bodies than wicks when we're observing price action, when we're gauging order flow. So the next chart I sent in, acknowledgement where price action has been hanging around ever since the 9:30 opening. One would see such a large BISI print and think to chance it or execute off of it to join in with the buying pressure, which is just a trap. So it's like 9:30 opens, we have very aggressive deliverance down towards sell side, and then we end up reversing straight up on this candle, very aggressive candle. A general party that engages with the markets are going to try and look to align themselves with this state of order flow. That is simply not going to work, especially if we're observing this price action on a deeper level. With this deliverance up towards buy side, cracking correlation presented itself here. We can see that ES engages with the high, NASDAQ fails to follow suit. And then another cracking correlation presented itself during this segment of price action here, which is actually a position that I just completely missed. And it was a very nice position in terms of the risk to reward and to look for that deliverance down towards sell side. But besides all of that, anyone who is seeing such a large displacement towards buy side is going to look to try and chase this. And when they do look to try and chase it, we end up seeing price action just completely reversing all back on top of this range. That, again, is a sign that this session was not going to print in a very nice manner. And then the cherry on top is the 1800 opening rests very nicely inside of the first presented fair value gap. So the 1800 opening is the settlement opening of our daily candle, which means that a power of 3 can be framed from this time in terms of an open low high close, open high low close. During the New York AM session, we're hanging around the 1800 opening, which automatically means that the daily candle is an indecisive candle. We know that indecisive candles don't know where they want to go. And when we're looking at price action on a lower fractal, we're seeing price action that can't decide exactly where it wants to go or do. It's not willing to deliver in a willing and meaningful manner. And then the next piece of commentary is further just elaborating on what I was just speaking about 2 seconds ago. So when I cannot come to a definite conclusion on where I want to see price action go, and I am able to frame both sides of the market, It's the first warning sign of poor conditions. Now, I've stated multiple times in my analysis videos, when you sit down to engage with the charts, understanding when, where, why, and how should come as easy as 2 plus 2. I'm going to ask you, what is 5 plus 5? You automatically, there is no type of thought to it. You automatically know what the answer is to such a question. It comes as if it's second nature to you. This is what it should be like when you sit down to engage with the markets. You automatically come to a conclusion that X, Y, and Z should happen at X, Y, and Z when X, Y, and Z happens, da 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 da. So the longer it takes for you to define when, where, why, and how, 90% of the time, it's conditions that you don't want to be engaging with. And I just refer to this as headache price action because it's all it ever used to give me during my learning days. So during my learning days, I always felt the need to know exactly what price action was going to do. And especially because of the fact that there were times that I knew exactly what price action was going to do. So I had it in my head that, well, if I knew what it was going to do 3 days in a row, surely I could know what it's going to do for the next 2, 3 days in a row. And there were times when I would look to engage with price action and I cannot come to a conclusion as to what price action is going to do. I'm two-sided in terms of I can see this happening and I can see this happening. And when I could not come to a definite conclusion, it made me feel a type of way as a trader in terms of how up to par my ability is. And only up until the point that I came to understand the fact that when I'm able to frame both sides, this doesn't mean that my capability as a trader is all of a sudden diminished. The shift in perspective was when I'm able to frame both sides, it is my experience speaking to me and it's my discretion in terms of normally I'm able to frame one side with a definite conclusion. If I'm not able to, this more than likely means that this isn't price action that I want to be engaging with. That's quite literally all there is to it. There is no point in me trying to force myself to try and figure out what price action is doing. Because when I did try and force myself to figure it out, what comes about? Headaches. Headaches, 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 headaches. So rule of thumb is if you lack the experience to understand that, okay, I can frame both sides, what should I look to do? When you notice correlated assets decoupling, it's simply just a sign for you to turn off the charts. I remember my first time experiencing correlated assets decoupling. I'm looking on one chart and it's delivering towards buy side. I'm looking at another chart, it's delivering down towards sell side. And I'm looking at the other one and it's consolidating. I'm confused. I don't know what to do. I don't know what to trust. The lack of experience in terms of seeing it enough times opens the individual up to mistakes, as well as framing ideas that are not ready in price yet. So when you look to come back is when time permits for assets to be in sync. Swing points forming at the same time, swing points being engaged with at the same time. Time is what permits for decoupled assets to couple up again. Because when we're looking at the decoupling of assets, we're only paying attention to price. We're not paying attention to time. Time cannot decouple. 1220 is going to be 1220 across all correlated assets. It cannot decouple. The only way that we can see an element of decoupling time is when assets form a swing high at different times or a swing low at different times. That is a form and the closest way smart money can get to manipulating time, because time cannot be manipulated. It's always going to constantly be printing at the bottom of the chart, being that x-axis. I'm not sure if I've mentioned it before, but when you're looking at a chart, you have the x-axis being time and the y-axis being price. If we're bringing this back to basic mathematics, the y-axis is a dependent variable on the x-axis. The x-axis is an independent variable. Take or make of that what you choose to. But away from that rather long tangent, the next piece of commentary would have been Thursday being the 25th, sending in a picture of the chart, M15 body standard deviation from previous day low, projecting for above the equilibrium of the range. Today's Asia session projecting for above equilibrium of the range, so standard deviation was anchored to Asia, but the grind towards buy side had been lethargic, serving in a high resistance manner. So just taking a look at that chart, what I am saying in that text would have been this standard deviation. This would be the low of day for Wednesday's price action. This is where we actually ended up taking that long position that I was mentioning earlier. But we have that standard deviation anchored to the bodies of the down close candles. Very hard to see because it's very blurry, but it's anchored to the bodies of the down close candles, as this would be the formation of your order block. -2, -2.5, -4, -4.5, projecting above the equilibrium. And then we have an Asia range standard deviation. So we have two, a body standard deviation and a wick standard deviation. We see that -4, -4.5, and this is actually where the high of the day just formed. It formed at this -4, -4.5, as well as that -2, -2.5. And it was 8:30 that delivered into our standard deviation to then have this very aggressive deliverance down towards sell side that we'll see in just a second. But even so, just saying the fact that it was 8:30 that delivered into this standard deviation is very key for the next video that I'm looking to drop, which would be just a higher time frame speculation update, because smart money's hand has been in the market as of recent times. So we end up seeing very aggressive deliverance down towards sell side from this 8:30 high, which would be a data high. And I simply just said that my higher time frame institutional order flow speculation I posted, I am starting to see it again. This AM move to overlap the PM move is intriguing works. Now, I'm going to look to touch on this in the higher time frame speculation video, but this is a low resistance liquidity run. This is a high resistance liquidity run. I seen deliverance to engage with the Asia low, engaging with all of this high resistance. I didn't see us continuing in a low resistance manner all through this segment of price action here. There are principles that the algorithm follows. Low resistance liquidity run, if we're delivering back down into it, high resistance liquidity run. High resistance liquidity run, if we're delivering back over it, low resistance liquidity run. The algorithm did not follow the principles that are set. This means that manual intervention has occurred. And the manual intervention is even more blatantly obvious with the fact that the high of day for Thursday would have been your 8:30 candle, which had high impact news. The only day of the week that had high impact news, if I may add. We've seen 8:30 engaging with buy side, buy side, buy side. Smart money selling the buy stops. This would be the market efficiency paradigm. And then the next segment I ended up sending in would have been a trade. Now, I haven't touched on any trades that I've taken over the course of the week. Neither am I going to. We're not actually paying attention to the trade. It's what I said in the text. So took this position on demo. The risk required for a valid stop loss placement was 100 points. Very volatile conditions, considering it was only 2 candles for the change in staying delivery. But I also wanted to see a cracking correlation present itself in price. Every fiber in my body was telling me this is a position to take. This is my model. But I was more inclined to see a cracking correlation present itself in price. I didn't see that when I was observing NQ, ES, or YM. There was no cracking correlation to promote this model being complete, being the inception model, as we're looking to capture the low of day. Upon looking to tape read it, executing on demo, tape read, demo, basically the exact same thing. The only difference is just clicking the button. The trade delivered. It delivered in a very nice manner. The model completed itself. Because the cracking correlation was presented, except it was Russell that presented the cracking correlation. And I then further went on to say that I have established a pattern through data collecting and forward testing. The months from May all throughout August, for one, different markets become more favorable for me when I'm engaging with price. So the likes of Euro USD, gold, crude oil become favorable assets for me to engage with. And then in relation to indices, during the May all the way to August, Russell becomes key in terms of framing ideas that I want to see. So just taking a look at the execution, I would have liked to see a cracking correlation present itself in price here. We end up engaging with this low, so do all other correlated assets. 10 a.m. opens right here. In a most ideal world, if I'm to bend the markets to my will, we fail to change the staying delivery and we form a cracking correlation right here, keeping the previous day low intact because we ended up seeing ES engaging with that previous day low. So I was looking to see internal structure cracking correlation, which Russell presented, but I wasn't paying attention to Russell as intently because when it comes to the chart and the way it's laid out, I only have NQ, ES, and YM on one chart, and then Russell is on like an intermarket relationship chart. It honestly doesn't matter. I would have looked to see a cracking correlation present itself, especially under that 10 a.m. opening. That would have been very, very nice, as well as the fact that we're going against all of this order flow. That is what we love to do. That is what we love to see. Everyone is trying to chase this move. They're saying, oh, it's just going to keep going down. It keeps going down. It keeps going down. They're going to look to try and get on side with this move. Little do they know this is a point of inception for price action to begin retracing back into this range. So the next piece of commentary would have simply been July 2025. So I ended up finding when I posted this into my Telegram. So it would have been July 2025 is when I started collecting data, and I'd seen it live enough times to add Russell to the mix, but I was observing it for a month and a half prior before I added it into the mix. And in relation to Russell, it played a very key part in relation to the deliverance of price during the course of this week when trying to frame price action. It wasn't only just this setup in which Russell played a factor in terms of confirming it. It played a lot of factors over the course of the week. So NQ, ES, YM, and Russell, 4 assets, but they can be split into 2 in relation to their correlation. So NQ and ES are a duo of their own. YM and Russell are a duo of their own. Now, the reason why I don't like YM is when I'm trying to frame certain ideas, trades, X, Y, and Z, it decouples with NQ and ES when it comes to forming swing highs and swing lows, which is why whenever an idea presents itself and YM is the one to present that idea or confirm what I am seeing ahead of time, I oftentimes look for more confirmation if time is not in sync. So YM is framing or forming swing points at different times compared to NQ and ES. But when you observe YM and Russell, they become a duo of their own in terms of they move in sync with each other in relation to forming swing points at similar times. And that would have been it for Thursday's price action. And lastly, Friday. Now, to be quite honest, I'm not quite sure how long this video is going to be. Thankfully, I didn't include the executions that I took because we'd probably be here for a lot longer. But with Friday's price action, sent in a chart with YM, NQ, ES, and Russell, saying that Russell serving the cracking correlation for expansion towards sell side during Asia. YM just being a donkey asset as per usual and forming equal highs, and then cracking correlation already established on NQ during the previous day, but every reversal is going to have a cracking correlation established. So taking a look at the chart, and this is what I was referring to earlier in terms of I don't have Russell when I'm paying attention to lower time frames. This chart is an intermarket relationship chart. I'm observing commodities down here and I'm observing indices, and then I have another one where I'm observing all markets. But we have YM on the very left, equal highs. We can take a notice of it because degrees 0, it formed equal highs. NQ cracking correlation, ES cracking correlation. If I'm only paying attention to YM, NQ, and ES, YM forming equal highs is going to throw me off. I'm not going to like it. I'm going to want to see one of these assets, being YM, NQ, and ES, revisit these equal highs for me to say, okay, now I can look to see that sell side delivery motion. But when we add Russell into the mix, we see that Russell ended up engaging with the high. Very important. These highs are being formed. The swing points of these highs are being formed at the exact same time. That is a very, very heavy factor when it comes to establishing valid cracking correlations, as well as other factors as well. But we end up seeing Russell presenting that cracking correlation, inviting for that sell side delivery motion, which is why we ended up seeing just ahead of Asia being the high of day for Friday's price action when we were doing a weekly review. It was permitted to stay as the high of day because it was deemed protected. And then the next piece of commentary I sent in, again, a trade, but we're not paying attention to the trade. We're simply just paying attention to the text. So New York AM, inception continuation model and inception model. Took inception continuation short towards Is that even English? I took the inception continuation short towards the 10 a.m. candle low and then scaled out the full position. And then I wanted to take longs from there, but it did not offer a valid framework for me to get on side with it. And then I took shorts and that's not even English as well. That's really not English. And then I took short, I think I'm referring to this. I took shorts and I was looking to see the low be engaged with. So being this low right here, I was aware of the time being ahead of the New York lunch session. So I anticipated for a high resistance liquidity run down towards my drawn liquidity being this low right here. But we ended up seeing YM engage with my target, serve a point of inception for buy side delivery motion to take me out. And then further went on to say that I've been executing on the M&Q contract as I am practicing pyramiding into positions as well as getting accustomed with it in terms of being able to calculate the risk in my head just automatically. But it's, evident in my recent executions that I've been displaying that as well in terms of pyramiding into positions. And then lastly, M&Q offers a better way to manage risk when scaling in, especially during this volatility when M1 candles average a range of 30 to 50 points. Now, let's say I'm to execute on the NASDAQ NQ contract, E-mini. I'm going to execute one contract. Stop loss is 50 points. I'm risking 1,000. That's well and fine. If I look to enter into my position again, if I look to pyramid into my position, I'm going to look to add one more contract again. It's going to be rather illogical for me to add, more than what I initially added into. And depending on whether my stop loss is permitted to move or not, my risk will become substantially a lot more. If my risk isn't permitted to move, all of a sudden I'm risking 2,000. The only way this is permissible depends on the operator's risk management protocol. But when it comes to pyramiding into positions, the way to do it effectively is to add a bulk of the position first, and then the next pyramided positions would be smaller than what you first added in, because your average fill will then accommodate for that position to offer a way larger risk to reward than you initially started with. So ultimately, it would mean that you're in a position with way more contracts than you started, but your stop loss is way smaller and your risk is way smaller than what you started with. So this would have been the execution, simply just pyramided once and was looking to target this low. This would have been the short position that I was mentioning that I took to take out 10 a.m., the 10 a.m. low. And I wanted to see a long position from here, but there wasn't any valid framework for me to look to say I'm okay to get on side with it. There was the inversion of this fair value gap, which we end up seeing being utilized, but simply still wasn't willing to get on side with that. And then the next image would have been, did you pay attention to the PD array matrix video I dropped on the inception model yesterday? So the mean threshold order block not closed above. Consequent encroachment of the fair value gap not closed above. Order block formed in the fashion of an FVG closing below it. Segment of price action is occurring during the 30-minute window. And then I went on to say that if you're curious about the short, go to Wednesday, New York AM, project that first presented fair value gap out in time, and then switch to regular trading hours and anchor a quadrant onto the opening range gap. Upper quadrant was utilized, and then on the M5 chart, anchor a body standard deviation onto the 1110 candle, and it's basically just magic. It's merely just algorithmic, a script. So this would have been the image that was sent in with it. So this is basically just the PD array matrix video that we took a look at, or that I dropped a couple of days ago. Series of up close candles, series of down close candles, series of up close candles engaging with a pool of buy side right here, series of down close candles closing below the series of up close candles, specifically the open, to confirm our order block. We also formed the order block while forming a bearish fair value gap. And then this fair value gap would be a breakaway gap. And then we also have a rejection block, old high. We're seeing the PD array matrix being printed out live in time as we're following the deliverance of price action. And then we have standard deviation anchored from this candle's high all the way down to this candle's low, -2, -2.5 reaccumulation, continue down, cracking correlation presented inside of a wick, -2, -2.5. And then I sent in another position just stating that I've always understood the concept of pyramiding into a trade and how the risk to reward increases as you continue to add into your trade effectively aligning yourself with the algorithm. Very important, because if you're just blindly adding into a trade and you don't know or understand when, where, why, and how to move your stop loss as you add into a trade, you might just fry yourself. But apart from that, I understood when, where, why, and how to pyramid, but I just never looked to do it. So I've simply just been putting it into practice for a while now, and I just stated that I find it fun following the deliverance of price. So specifically this was a very fun trade to manage as well as pyramid into it. Point of inception, and as we're pyramiding into the position, we're observing the higher time frames, looking for that lower time frame to, very nice. But I'm not going to talk about it too much, because once again, we're going to be here for a lot longer. And then next chart would have been inception model. By following the objectives, we'll capture high of day, high of the session, like stated in the introduction of the model. So we see that we have the high of day, which is where I took short, which would have been here, and I was taken out of that trade. And then we have the high of the session, which is where I would have taken the next trade. So high of the session being high of the PM session. So yeah, that would be it in relation to the weekly review for this week. I haven't done one of these in a while, so I'm not quite sure how nicely constructed the video was in terms of me staying on point, but yeah, that would be it for the weekly review.